Three words, Moon Platoon: margin call squeeze. We talked about how market crashes, especially during the critical times when a hedge fund has oversold, overshorted a stock. We know that they are now vulnerable to a potential margin call squeeze. Jeremy Grantham, famed investor who for decades had been calling for market bubbles, said the historic collapse in stocks he predicted a year ago is underway, and even intervention by the Fed can't prevent an eventual plunge of almost 50%. So, are we actually paying attention to the events of last January, of a vulnerable market, of when the amount of money hedge funds had to throw around suddenly depleted? They now have to make a very important choice. Sync. Watch to the end of the video. Make sure you guys have already slapped that like to get more investors into this video. That's how the algorithm works. Let's destroy it together. And just for meatball's sake, make sure to leave a comment about what you think he's thinking about right now. Let's take a look. First of all, why is there going to be a potential super bubble popping in the near future? Is that a likelihood that can drive up margin call squeeze when a series of hedge funds find themselves unable to be able to afford the short position that they have accrued? Then they are automatically, not their decision, they are automatically cashed out, which causes a further sell-off across the entire market. When that happens, then they have to buy back their short position at a cascading level. It gets exponential pretty quick. In a note posted Thursday, Grantham, the co-founder of Boston asset manager GMO, describes US stocks as being in a super bubble, only the fourth of the past century. And just as they did in the crash of 1929, the dot-com bust of 2000, and the financial crisis of 2008, he's certain this bubble will burst, sending indexes back to statistical norms and possibly further. We know that this last year has been the year of the retail investor. That's why it's been so easy for normal mom, pops, and even just brand new, straight out of college, straight out of high school sometimes, you are investing right at your fingertips. Now, could it be the year that the market bites back? In that, he said, involves the S&P 500 dropping some 45% from Wednesday's close and 48% from its January 4th peak to a level of 2,500. The Nasdaq Composite, already down 8.3% this month, may sustain an even bigger correction. Take a look at this man's face. He's not joking around. I wasn't quite as certain about this bubble a year ago as I have been about the tech bubble of 2000, or as I had been in Japan, or as I had been about the housing bubble of 2007, Grantham said in Bloomberg Front Row interview. I felt highly likely, but perhaps not nearly certain. Today, I feel like it is about nearly certain. In Grantham's analysis, the evidence is abundant. The first sign of trouble he points to came last February, when dozens of most speculative stocks began falling. One proxy, Cathie Wood's ARK Innovation ETF, has tumbled by 52%. Next, the Russell 2000, an index of mid-cap equities. You guys know this. Those of you who have already subscribed, hit that join button down below, have been patrons on Patreon, already have heard about our analyses of the Russell 2000. Pay attention. Let's join in. Index of mid-cap equities that typically outperforms in a bull market trailed the S&P 500 in 2021. Finally, there was what Grantham calls the kind of crazy investor behavior indicative of a late-stage bubble: meme stocks, a buying frenzy in electric vehicle names, the rise of nonsensical cryptocurrencies such as Dogecoin, and that hurts, guys, multi-million-dollar prices for non-fungible tokens, or NFTs. This checklist for a super bubble running through its phases is now complete, and the wild rumpus can begin at any time. Grantham, what's his age in there? 83, writes in his note. That's why he says rumpus. When pessimism returns to markets, we face the largest potential markdown of perceived wealth in US history. Or perhaps just the transfer of wealth, the revolutionary transfer of wealth that we have been talking about this show for roughly about a year now. This is our anniversary of when we really started talking about that financial transfer. When the very, very wealthy have had overinflated, hyperinflated amounts of wealth for the last decade and rising, take a look. That major deviation from the trend can be corrected into returning to the pockets of people who had been on stalwart, strong, silver platinum levels of ape holding on to their diamond hands. It could, he said, rival the impact of the dual collapse of Japanese stocks and real estate in the late 1980s. Not only are equities in a super bubble, according to Grantham, there is also a bubble in bonds, the broadest and most extreme bubble ever in global real estate, and an incipient bubble in commodities prices. Even without a full reversion back to statistical trends, he calculates that losses in the US alone may reach $35 trillion. You guys took a breath right now. It's because this is heavy. The roaring 20s were supposed to give us a decade of prosperity, right? That's our century-long anniversary. But now we're looking at the 30s, the Great Depression coming even earlier than we can imagine. Is this now the precipice of how these mechanics are going to boost buybacks? So let's talk about that real quick. I'm going to pull up my pen. I'm just going to be able to draw in the simplest of terms exactly what a potential margin call squeeze could look like. When you guys take a look at a potential margin call squeeze, you're paying attention to how much money, oh yeah, make one yellow bar here, a hedge fund even has. Let's call this hedge fund number 1. When this starts to accrue with the amount of debt that they have, that is a rising risk that they will get margin called. So this is the amount of short positions that they have, other liability, right? However, the amount of yellow could deplete, because if you're paying attention, you could start having a market crash. Not all of it should disappear at once. I'll use blue to indicate that it is depleting, right? As the market depletes the amount of funds that this hedge fund has, the margin call chances increases as well. Then once this buyback action happens, when this hedge fund has already been knocked out of the game, that amount of price action rising for a GME or AMC equivalent could end up bankrupting a larger hedge fund, someone who has more funds than the original hedge fund one. Once you are playing around with a cascade, that could start becoming an escalation that we could only say rivals the January squeeze of 2021. All right, this Grantham is a dyed-in-the-wool value manager who's been investing for 50 years and calling bubbles for almost as long. He knows his predictions are fodder for skeptics. One obvious question: how could the S&P 500 advance 26.9% in 2021, its 7th best performance in 50 years, if stocks are poised to plummet? Rather than disprove his thesis, Grantham says the strength in blue chip stocks at the time of weakness in speculative bets only reinforces it. This has been exactly how great bubbles have broken, he said. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85%. They had crushed the market. Seeing the same pattern that played out in every past super bubble is what gives him so much confidence in predicting this one will implode similarly. Grantham pins the blame for bubbles of the past 25 years mostly on bad monetary policy. Ever since Alan Greenspan was Fed chairman, he argues the central bank has aided and abetted the formation of successive bubbles by first making money too cheap and then rushing to bail out markets when corrections followed. Now investors may no longer be able to count on the implied put. Inflation running at the fastest clip in 4 decades limits the Fed's ability to stimulate the economy by cutting rates or buying assets. They will try, they will have some effect, he added. There is some element of put left, it is just heavily compromised. Under these conditions, the traditional 60-40 portfolio of stocks offset by bonds offers so little protection, it's absolutely useless, Grantham said. He advises selling US equities in favor of stocks trading at cheaper valuations in Japan and emerging markets, owning resources for inflation protection, holding some gold and silver, and raising cash to deploy when prices are once again attractive. Everything has consequences, and the consequences this time may or may not include some intractable inflation, Grantham writes, but it has already definitely included the most dangerous breath of asset overpricing in financial history. What do you guys think about the Nostradamus of the overall stock market, and what do you guys think about the potential margin call squeeze that can follow? Comment down below, once again, if this information was either educational, informative, or got you thinking about how to pursue your own financial future. The first step to investing in yourself is hitting that subscribe button and clicking that like button if you like Professor Meatball's input. Thank you guys. Thanks to all of you who have supported the show, and for now, but not for forever, I'll see you guys in the money. Peace.